All right, today we're going to learn how traders describe options. And we describe them in three different categories. We describe them as either in the money, at the money, or out the money. And if you remember, we did actually discuss this in one of our previous lessons 2 or 3, I can't remember exactly, but we talked about this. And we used a house as an example. So I want to kind of go back to the house and try and see if it makes more sense, refresh our memories, and then we're going to dive into a few different slides. And so if we look at this, at the money is when we purchase an option. So in our house, if we purchased a $100,000 option, right? If we purchase that option, then the house is worth $100,000 and we have the right to buy it at $100,000. So this option is what we will call at the money. The value of the option is the exact same value of the house itself. And so then if we go to the next one, we're looking at out of the money. Well, in this case, the house is still worth $100,000. Okay. But now we are purchasing the $120,000 option. Okay. What that means is that we have the right to buy the house at 120 and sell it to somebody else at 130, 140. So right now, currently, the house is only valued at 100,000. We can't sell it to anybody. We would actually lose money on that. So that is out of the money. This option has no equity. And you're going to learn a new word today. It's called intrinsic value. Equity and intrinsic value are the exact same thing. We just use equity for houses and we use intrinsic value when we're talking about options. And so then obviously, if we look at the very next one will be what we call in the money. And so the house is still worth 100,000. We have the right to purchase it at 80,000, right? And so because the house is worth 100 and we can purchase it at 80,000, this house has $20,000 worth of intrinsic value. Okay. And so that is how we look at options and how we view them or how we describe them when we're talking to other people or we're looking at the option chain. So let's actually describe it a little bit deeper. So here's how options are actually priced. If you take the intrinsic value, so I'm not going to use 100,000. I'm using just $100, right? Let's use $100 instead of 100,000. So if I have the strike price of $80, but the stock is worth $100, that has $20 of intrinsic value. Okay, already built into it. And then if you remember from before, I said that if you bought, I was using insurance as an example. If you bought a 30-day policy, you would pay one price for it versus if you bought a 60-day policy for car insurance. And so you're going to pay more for the 60-day than you would for the 30-day. So if you take the time value plus the intrinsic value, that is where you're going to actually equal the options price, okay? So the actual value is how much money is built in, intrinsic value or equity, versus how much time is left on the option, and that time will actually tell you how much the option is worth. So let's look at a graph that we actually drew before and try and clarify this a little bit more, okay? So let's say that we have a strike price of $30. We have an option as a $30 strike. And let's say that the stock is currently at $30. Well, that would be the at the money option. The option is equal to the stock price. So because the stock is at 30 and we have the right to buy it at 30, that option has no intrinsic value. It only has time value. So currently, whatever we're paying for this is just based off of what is the expected move or what could happen in the next 7 days, in the next 30 days, in the next 60 days, okay? That is how you get an at the money call option. And so if we look at in the money, same thing. We have the $30 strike, okay? I should just leave this up here versus rewriting it every time. But now the stock is at $35, okay? And so what's happening with that is because we have the right to buy it at 30 and the stock's at 35, we actually have the ability to make money on it. That has equity or it has intrinsic value. That is in the money. It actually has some value behind it. Okay. And then obviously the complete opposite of that would be the same thing. We have the $30 strike price still, but now the stock is at $25. And so this is what we'll call out the money. The reason it's out the money is because if I could buy something for $25, why would I buy it for $30 in the open market? So currently, this option, the $30 strike, has no value. The only thing it has is just time value, but it is out the money. And so now I wanted to I took a screenshot of, this is still the Thinkorswim platform, and we are looking to SPY, and actually took a screenshot so it would be still, so the numbers wouldn't keep moving on us, so we can actually really dissect this. So we are looking at the calls on the left side and the puts on the right side, just like before. I have the actual columns. I have the intrinsic versus the extrinsic value on the call and the put side. And so when you look at this, you can see that if we go to first thing I want you to notice is that it is grayed in over here. And that is how you know that that is in the money, and it's on the call side, and is also grayed in over here on the put side because they are opposite of each other, right? And so you can always see what is in the money on the call and the put side. And how do we determine in the money? Well, if we look at this, and we look at the intrinsic value, you can see that this has 41 cents of intrinsic value. What does that really mean? The stock, this is our 668 strike price. The stock is at 668 and 41 cents. And so we actually have 41 cents of actual value. If we purchase the stock for 668, we could sell it for 668.41. So there is 41 cents or $41 of value. This is where I was telling you that there is no free lunch in the stock market. Everything is priced in. So when you take the actual intrinsic value plus the extrinsic value, which is the time, just the time. So this option, if you remember, we talked about it, has 7 days to expiration. It expires October 29th, 2025. If you take the 41 cents plus the $5.55 and you add that up, that is what gives you the bid-ask, which is what we have right here, the bid-ask spread. And so that is how they actually price the options based off of the extrinsic value and the time that is left. And so you'll notice that every single thing outside, these are all out the money. That's why they have no intrinsic value, because 669 is above the current stock price. And so nobody's willing to pay you 669 when they could actually buy it for 668.41. And so the only thing that you see here, the only value that these options have is just the time value, just the time value. And so what they're saying is, hey, in the next 7 days, it's possible that the stock could increase in price. And so as it increases in price, this option will actually gain intrinsic value potentially if it goes up in price. And so you'll notice that because the probabilities of it going from 668, where it's currently at, to 669 are greater than it going from 668 to 675, you are paying more for this one right here, for the 669, than you are the 675. There's a lot of sixes in there. So really what we need to recognize is that as you get further and further out the money, you pay less and less for the option. And as you get further and further into the money, you pay greater for the option. Okay? And if you really look at this, it's the exact same thing on the put side. It's just completely opposite. So because a put, you have the right to sell it to somebody at that price. Every single thing that's below, if I can sell it to you at 669 and then purchase it for 668, that has intrinsic value of 59 cents, right? But if I can sell it to you for the current price of 668.41 and then buy it at 668, that has no intrinsic value. So you see that you have no intrinsic value here, and it's the exact same opposite. As you get further and further into the money, the price increases, And as you get further and further out the money, the price decreases. And so that is how you actually get the value of your options based off of time and intrinsic value. So intrinsic value is actual equity, and extrinsic value is just time. And so on the next lesson, we're actually going to dive into all the Greeks, which is the delta, theta, vega. And I know that all probably sounds Greek to you currently, but the same way that I was able to explain at the money, in the money, and out the money, I hope that I can explain the Greeks to you so they make perfect sense and that you will come away much more confident and much more ready to begin your options journey.